Kaplan, we want to welcome you. Mr. Richard Koo, we want to welcome you. And also Mr. Gonzalez, Victor Gonzalez, our Deputy Chair. We want to welcome you. We also have members joining us from the NYCHA board and the management staff. We have members from our external auditors, Deloitte and Touche, and also want to welcome our technical team, our technical support team. Without them, we couldn't be advanced in this meeting. And any other members who may be joining us from the public, we want to welcome you to this, our New York City Housing Authority Audit and Finance Committee. Before we go into our agenda, we're going to have our roll call, and I'm going to ask our internal audit member, Anil, to lead in this regard.
Yes, hi, good morning, everyone. This is Anil Agrawal. So for the roll call, we have present Mr. Gonzalez.
Present.
Mr. Kaplan.
Present.
Mr. Koo.
Here.
From Deloitte, we have Jill Strohmeyer.
I'm here.
Darshan Patel.
Present.
Johnny Waldsmith.
Here.
And from finance, we have Anika Lescott.
Present.
Jeffrey Lesnoy.
Present.
Vilma Huertas. Terence Clark is here.
Present.
Myself, I'm here. Ayat Lee.
Here.
Adam Chukri.
Here.
Do we have Daniel Green? Rasul Azarnejad. So those are the key members. Did I miss anybody else? And of course, we have technical support team from both IT as well as AV, audiovisual. And also we have Kara from the Zoom. Welcome everybody. And thank you for all the support and attendance. We can start the meeting.
All right, thank you very much, Anil. We have a PAC agenda this morning. And as we begin, we want to get the approval of our last audit committee minutes, which was held on April 22, 2021. Motion is in order.
I
So
move.
moved.
That's been moved.
Second.
And it has been seconded. May the record so reflect that. We go right into our agenda. We will be having our New York City Housing Authority Consolidated Comprehensive Annual Financial Report 2020. We'll also have the NYCHA Public Housing Preservation LLC 1, that is a Comprehensive Annual Financial Report for 2020, and the NYCHA Public Housing Preservation Comprehensive Annual Financial Report for 2020. I will now ask Jeff from Finance to lead out in this regard.
Excuse me, sir, Mr. Clark.
Yes, Mr. Koo.
Do you need to formally say that the minutes were approved after being seconded? Could you please request that they be approved?
Thanks for that point of order, Mr. Koo. All right, back to our minutes quickly. The minutes have been approved. That's been moved and seconded. And the minutes has formally been approved.
Well, you all have to say aye.
Okay. All those who say aye?
Aye.
Aye.
Okay, the members say I have it, unanimous.
So now it's approved.
Thank you.
Thank you.
Now we move right into Jeff. You'll present the financial statements.
Good morning, Audit and Finance Committee members. Earlier this week, a full set of annual financial statements were distributed for your review as it relates to the years December 31st, 2020 and 2019. And this included financial statements for each of the following: New York City Housing Authority, NYCHA Public Housing Preservation 1 LLC, and NYCHA Public Housing Preservation 2 LLC. Such financial statements are comprised of statements of net position, and related statements of revenues, expenses, and changes in net position, and statements of cash flows and the related notes to the financial statements, all presented in conformity with generally accepted accounting principles, GAAP. Also included within these financial statements is management's discussion and analysis and required supplementary information to be read in conjunction with the financial statements. The financial statements are being provided in order to afford the members a comprehensive understanding of financial activities of the entities during the year. As it is not practical to walk through each page, I intend to first focus on some broad issues that have impacted the financial statements and also spend some time walking through the select statements at a high level. Kara, could you move to, you're on page 1 already, which is great. So I guess I want to start, I think page 1, please. Right. Okay, thank you. So I want to start with real estate transactions for the year because there were some big events during the year. Under our PAC program, we closed 2 major transactions, which were basically the Brooklyn bundle and the Manhattan bundle, each established as 99-year leases. And approximately 4,300 units were included in these transactions.
I'd love to talk to you. I'll call you back.
And the goal is to facilitate conversion of apartments from public housing to Section 8, and ultimately to allow the developers to finance building repairs and improvements while preserving long-term affordability. So from an economic perspective and what hit our financial statements, we'll first talk about, consideration, compensation on the transactions. Between the 2 of these, we received $123 million of initial rent payments. We received a $20 million purchase money note, which will be paid off over a 40-year period. And we received $20 million of developer fees. So that's all real cash, real financial consideration. But however, from a GAAP perspective and a financial statement perspective, the majority of that compensation is to be amortized, to be recognized over a 30 to 40-year period, as per GASB statement number 62. So when we look at the financial statements, we're not going to see $123 million of revenue recognized. That will be reflected in an unearned revenue category in the statement of net position. In addition to the compensation named above, we also have the right to receive annualized capital lease payments on the Brooklyn bundle based on available cash flow. There is a schedule. We actually received $3.8 million in May of 2021, the first year out of 99. There are escalating payments of 1.5% increase over every year of the lease term. It's all based on available cash flow, but there are provisions that if cash flow doesn't allow for it, that the payments will be deferred to a future date. In addition, we entered into a $30 million secured loan participation, which we purchased from HDC. HDC generated $70 million of loans, 40 different loans called the Sun Loans, and we purchased a $30 million participation in that. It's oversecured by collateral, and we'll see that on the statement of net position. And we have not had to record an allowance for doubtful accounts in that because of the security that's there. So at a high level, those are the 2 large real estate transactions that occurred during the year that will be affecting the financial statements. In addition, we had one other notable transaction on the Ingersoll development where we did not actually enter into a lease on the property, but we sold some vacant land and development rights and recognized about $25 million of cash in revenue as a sale in 2020. So that is included in revenue in the financial statements on the statement of revenues and expenses in that position. Garrett, can you move to the next page, please? Thank you. There are 2 other noteworthy events during the year. The first one, not surprisingly, is COVID-19. It had impact, throughout the world, throughout the country, and throughout the economics also of NYCHA. NYCHA from the beginning took this very seriously. We took it as Yeah, I'm sorry, I heard some interruption there. So NYCHA has committed to taking emergency protective measures to sanitize facilities, provide safety to residents and employees. This includes sanitizing facilities. It includes building fences around playgrounds. It includes providing air conditioning to seniors for their units to basically substitute the fact that they weren't able to enter community centers due to social distancing, and a variety of other types of costs in order to provide services. That all added up to a significant value in 2020. We've reflected about $78 million of costs on our statement of revenues and expenses relating to COVID-19 activities. And that's for our public housing program. We incurred an additional $10 million of costs for the Section 8 program during the year. With that said, while we incurred some costs, we did also receive some federal funding to support the operations under the CARES Act. So for public housing program, we actually received a grant for $150 million, of which $120 million was drawn down in 2020, and the balance will be drawn down in 2021. And this was basically, based on the rules of the CARES Act to prevent, to prepare for, to respond to COVID-19 activities, and also to include maintenance of normal operations. So there was a certain amount of flexibility involved as to how public housing authorities utilize the funding. So during the year, we recognized $120 million of revenue under public housing, $10 million of revenue under the Section 8 CARES Act. And we will draw down, actually, we've received $30 million under the Section 8 grant, and we intend to use the additional $20 million within year 2021. In addition, FEMA has provided some support on a 75% of eligible cost basis. So we share in the 25%, received $8 million, and we recognize that as revenue in 2020. Lastly, we can expect that due to the significant impact on our local economy and the impact on tenants personally, from an unemployment perspective, from a lost wages perspective, et cetera, that there was an impact on the ability to pay rent. We expected to see it, and we were not surprised, unfortunately. There was a very significant decrease in rent collections beginning in March 2020, and it's continued through 2020, through the full year, and into 2021. And as a result of that and other factors, which we cannot specifically identify, we needed to record an additional allowance for doubtful accounts for tenant receivables of about $91 million. So those are the financial impacts of COVID-19 that we'll see threading through our financial statements as we take a quick walkthrough later. And lastly, we'll talk a little bit about pollution remediation obligations. I addressed this topic in last year's Audit Committee meeting. And basically, there are various regulations that require us to remediate and abate lead. First, our local New York City Law 1 requires landlords to prevent lead poisoning, take action to prevent lead poisoning in children under 6 years old. In addition, in early 2019, NYCHA entered into an agreement with HUD and the U.S. Attorney's Office for the Southern District of New York and the City of New York. And NYCHA agreed, among other things, and this was not limited to pollution remediation, but one of the major factors that we'll talk about here is NYCHA agreed to perform visual assessments, perform remediation, which is short-term painting cures for lead issues, long-term abatement of apartments and internal common areas over a 20-year period, and abatement of external common areas. So we are held to a standard of remediating and abating activities on a scheduled basis, and we've met the criteria of the underlying accounting statement, GASB 49, which requires recognition of pollution remediation for all expected costs, not just for the costs that we expect to incur in the current year or next year, but as long as it takes in order to abate the full problem. So when we went through this process, we identified that of the full 172,000 apartment units that we had in the beginning of 2019, that 134,000 of those were subject to testing and potential abatement activities. And the remainder of the apartments, about 38,000 apartments, had exemptions, HPD exemptions. They were previously abated or tested, or they may have been built after 1978, where the lead paint standards were different and therefore no longer required. So just going back in time, as of December 31st, 2019, we estimated and recorded a liability of $2.8 billion. This is a process now which we need to continue on an annual basis to determine how much obligation we have from a financial perspective, what are the activities that drive that process. And as we went through that process, we determined that our liability was actually a little lower in 2020, about $2.6 billion. And one of the main drivers for that is the testing process. We go through each apartment unit. Eventually, we'll complete each of the 134,000 apartment units with an XRF testing. And yeah, I apologize. I have a phone ringing in the background and I can't get to it. So we went through a testing process, and in 2019, we estimated that about 32% of the population would be subject to lead abatement. And that drove some of the number calculations as far as the $2.8 billion. When we went through the updated process in 2020, and we collected a much greater sample of the population. So as of this point in time, we've actually tested about 50% of the units. We've determined, and excuse the typo on this page, but we've determined that 27% of the units have positive lead in it, as opposed to 32% last year. So as a result of this caused us to reproject our calculations, and we reduced our lead liability. But in addition, we also looked at estimates for what it would take in order to abate and paint and do other type of activities that would remove the lead from the apartment units and the common areas. And we found that some of those costs actually increased over our original estimates. So on a net basis, we ended up with a projection of $2.6 billion. From an expense perspective, on our statement of revenues, expenses, and changes of net position, we treat this as what's called a special item, because the event is under management control, and it's unusual in nature, and it meets the qualifications of a special item. It's infrequent and under management control to resolve. So one other point that's kind of noteworthy is the cities of New York's obligation under the HUD-SDNY agreement. And the city has agreed to provide incremental financial support to NYCHA of $2.2 billion over a 10-year period. And within the HUD-SDNY agreement, the actual sources and the uses of that funding are not specifically defined. It's referred to an action plan which needs to be created, by NYCHA management and approved by the Federal Monitor. And, that action plan was just approved back in May of 2021. And of the $2.2 billion, $772 million has been allocated to lead paint abatement, while the others has been allocated to activities that are unrelated to lead, but are within the 6 pillars of the agreement. So with that said, and before I go on to the specifics of the statements, are there any questions?
Just one, Jeff, and it's when you first started the presentation, you were talking about the $123 million, right? And you said that that's going to be, I guess, prorated during the years till we get to what, 30 or 40 years into the future?
That's correct.
Okay, so every year though, something has to show on the books, right?
That's correct.
And
yes,
is that the 1.5% that you're talking about?
No, they're actually two separate issues. Kara, would you go back to the first page, please? One more. No, that's the third page, please. The first page. Yes. Okay, so on the first bullet, the $123 million were initial rent payments combined on the Brooklyn bundle and Manhattan bundle.
Okay.
And those per the existing leasing standards, GASB statement number 62,
okay,
need to be amortized over a period of time. The maximum period of time would be the lease, 99 years. But there are other conditions that are required. You look at the right of repurchase, right of first refusal, other type of conditions in the agreements which might signal when the revenue should be recognized. So we've determined, depending on the cash flow stream, that'll be recognized over a 30 to 40 year period. The developer fees are recognized when the services are provided, and those services will be provided over the next 1 to 2 years. So the developer fees will be recognized to revenue in the very near future. But these initial rent payments and the purchase money note over a 30 to 40 year period.
Okay. And now when you mentioned the Brooklyn and the Manhattan bundles, I know that there's more to the bundles than have that yet. Let's just say the conversions aren't completely done yet in those two bundles. Am I correct in assuming that?
Yeah, that's my understanding, but I'm not the best equipped to answer that question.
Okay, because well, what I'm trying to say is this is the current dollar amount for what has been completed. And when you use, for me anyway, when you use the term bundle, I'm assuming that that's every conversion that's going to happen in Manhattan and every conversion that's going to happen in Brooklyn. So is that number going to change within the 30 or 40 years?
Is the 123 million going to change?
Yes, because you're going to have more developments in those bundles that will be converted, no?
So, Mr. Gonzalez, if I can jump in,
Okay.
I think I want to get to the heart of your question, which is, I think the way that the real estate team has defined it, this sort of Brooklyn bundle is a group of properties, and they're calling it, the Brooklyn mega bundle. So that's
Right.
one group of properties that closed. There's also a Manhattan mega bundle, that's another group of properties that closed. There could be other properties that convert through RAD, but those would not be included in these bundles, right? These bundles are sort of specific transactions that include a specific number of developments. I hope that makes sense.
Well, it makes sense, but and the way you explain it, yes, it makes sense. But what I'm saying is this: usually, when you say bundles, it includes everything within that borough. But
No.
and I know it's okay. So you're taking the
there could be
bundles
other
as they go.
Correct.
Okay.
So there could be other developments in Brooklyn that convert. There could be other developments in Manhattan. This is a specific group of properties that they package together.
Okay. Okay.
That's a great question, though.
Now it makes
jargony
sense.
term that we use that we should be more clear about.
Okay. Okay. I got it now.
Excuse me, Mr. Lesnoy.
Yes.
Richard Koo here. Can I just step back a little bit in terms of, I'm trying to understand how NYCHA gets a $20 million developer fee for the conversion from I guess PHA to Section 8. I mean, I understood Section 8 primarily to be private owners of properties, not public. Is that a misunderstanding, or does Section 8 also apply to public housing?
Yes, so you could be a public housing authority that also has Section 8 units. It's not necessarily just for private owners.
Okay, so how does the developer fee come into play there? I mean, who pays for that developer fee?
That's a great question that I think is, Jeff, unless you know the specifics, is probably best answered by real estate, so we could get back to you. But my understanding is that it is borne by the transaction. So as a part of the agreement and the documents, we come up with a fee structure, and that fee is paid to NYCHA out of the deal. Jeff, do you know more specifics than that?
No, I think that pretty much covers it. And I can also say that this is not non-standard, that on every PAC transaction prior to this, there have been developer fees.
Yeah, understood. However, in the previous RAD PAC agreements, there was a private entity like a Bank of America or a Citibank that took over the purchase of those properties, or at least now in this case, who is there a private developer taking over these or not? I don't understand. I just don't understand the basis for how we're saving money here.
Well, that's something that we will refer to the real estate group, and we'll get back to you on.
Okay, because this is a big item, particularly as you're going to be moving forward, doing additional conversions in the future. So I just need to understand, how this is working.
So Mr. Koo, Jeff is right. We can certainly get the details and the deal structure to you from the real estate group.
Thank you.
And Mr. Kaplan, I think you were talking, but you were on mute. If you were. You're still on mute.
Yes, you're still on mute.
You have to call him and get him off of unmute. Somebody from IT needs to call him.
Mr. Kaplan, try now.
Okay.
Can you hear me?
Yes, we
Yeah.
can.
Okay. My understanding of these things, they're driven by all kinds of things, most of which relate to the federal tax rules. And
Right.
This is a
Right.
way of raising the money. And I've seen it elsewhere. I can't define it, but it's not an unusual set of transactions.
Oh. I just wanted to understand how this is working, that's all. So Annika will get back. So somebody from finance will get back to us on this at some
Yes,
point.
we will.
Thank you. Thank you.
That's a great question. Thank you.
Okay.
Okay, if there are no other questions on there, we'll dive into statement of revenues and expenses and changes in that position for NYCHA. If you can go one more page, please. Okay, so one of the reasons why I took a broad-based approach at the beginning was in order to answer some of the questions at a high level. So if we look at operating revenues, we'll see that operating revenues have decreased by about $97 million from 2019. And most of that is coming from the tenant revenue. Now, of that, we've determined that about $17 million of the reduction year to year is coming from the fact that we have less apartment units because of the PAC transactions, and that's to be expected. But the balance of that difference, probably about $80 million, is due to higher unemployment, less spendable wages. We cannot distinctly say that it's all due to COVID, but certainly the economic woes in the city affected the tenant's ability to pay rent. So this is a big driving force there.
And you do not expect to ever see that rent paid, do you?
Well, we haven't been successful in collecting it as of this point in time. And, the arrears has continued to grow. In addition,
I'm not questioning it. I think it's a very good thing that you can't squeeze money from the people who are so adversely affected.
There is one silver lining, Mr. Kaplan, that we might see in 2021, but it's still a little tenuous. There's an emergency rental assistance program that's happening at the state level, whereby tenants can apply to receive money from the state to pay back their arrears, and that money would go directly to the landlord. So it's a new program. There are obviously, many kinks to work out, but we anticipate that we could see some revenue from that. But based on the rules of the program and how early it is, it's a little difficult to even estimate what that could be at this point. But hopefully we have some good news for you next year if we're successful.
I guess my attitude has been that if these people can't afford it because they haven't got the money, it's good that we don't try to collect it from them.
Right. And this program is great because it would come from the state, not from the tenant. So the state would pay it on the tenant's behalf.
I think that's good.
So from an operating expense perspective, in total, increased by about $330 million, or about 8%, to $4.3 billion. And there are a few drivers in that. If you scroll down to a line that reads OPEB, OPEB stands for Other Post-Employment Benefits, and mostly includes, retiree health benefits. This increased by about $130 million year on year, pretty big increase. And, largely due to a reduction in the discount rate on how the liability is calculated. I think we're going to see that in a lot of places with interest rates and investment yields way down in 2020. The discount rate was reduced from 3.26% to 1.93%. It's a non-cash event, but it still affects our expense and our liability. Another factor, if you go to the top expense, Kara, the rent for leased dwellings, we'll see that this is Section 8 rent, increased by about $78 million, the lease housing program. And it's basically just due to higher payments per voucher unit and due to an increase of number of units. But with this, Kara, I think if you could go back to page 5. Right. So we're talking about the rent for leased dwellings. So with that $78 million increase of expenses, we have a corresponding increase in our subsidy for our Section 8 housing assisting program. And we can see that in our subsidies and grants, as that's one of the parts for the increase between 2019 and 2020. In addition, we see that depreciation increased from $371 million to $401 million, about $30 million. This is a direct result of our continued efforts to make building improvements throughout NYCHA. And when we place new assets into service, we begin to depreciate them, and it shows up in this line item as an expense. And other than that, there's expense increases throughout the line items there. As we discussed, we have about $78 million due to COVID-related expenses, which explains most of the rest of the difference in operating expenses. So I think those are the major categories in the operating expense change from year to year. And if we go down to non-operating revenues increased by $374 million, 15%, to $2.760 billion. The biggest piece in that is the subsidies and grants, where we had an increase of $205 million. Some of this we've spoken about already. In fact, I think most of it we have. We talked about the CARES Act, the public housing piece of it. We received a $150 million grant, relating to COVID activities. We drew down $120 million. $120 million is showing up in 2020 as a subsidy revenue. We have the $10 million from the CARES Act Section 8 sitting in here. And as referred to above, we have the increase in the Section 8 Housing Assistance Program by $77 million. So those are really the major components of the growth from year to year. The public housing subsidy is roughly the same as 2019. It's $974 million, down by about $27 million. And the other large driver that sits in non-operating revenues is the gain and loss on real estate transactions. And I think to start, we need to talk about what happened last year, because that's driving the change. We had $147 million of losses last year. And this related to largely two different transactions on a previous PAC deal, the Ocean Bay Bayside deal, where we needed to evaluate for impairment of a loan and evaluate for impairment of an investment on that particular transaction. And as a result of that, we determined that we had $154 million valuation loss where we had to write down the loan values and the investment values in 2019. In 2020, we don't have any large unusual events. You know, we have some small amounts that we amortized in to revenue from the Brooklyn bundle and Manhattan bundle. But, you know, to Victor's question earlier, we're not going to see most of that in any one particular year, which is why you don't see a huge number. We do have the Ingersoll transaction, which I described, which was a sale of land and development rights for $25 million, and that's flowing into the gain on real estate transactions. Other than that, it's relatively small items here and there. So I think the last point to discuss on the statement of revenues, expenses, and changes in that position is the special item. And when we went through the broad preview of the financial statements, we talked about the large $2.8 billion liability that we reflected in our 2019 financial statements. And we recorded that as a special item in 2019. In 2020, the adjustment for expected cost reductions is also showing up as a special item. In fact, all adjustments that take place going forward, up or down, to the pollution remediation will show up in special items in future years. So with that said, the net position has moved up by about $646 million from year to year, based on everything that happened above it. Kara, could you go back to the previous page, page 4, please? And some of you may need to increase the size of this on your screen. I think that could be done individually. Does anyone need help with that, Kara? Okay. So cash and investments are scattered throughout current assets and non-current assets in various different categories. Some of these are because they are current, some of these because they're long-term and classified as non-current. Some of them are for restricted purposes. So this is all based on standard GAAP and GASB requirements, but it's difficult to see the big picture, so I'll summarize that for you. We have $1,717,000,000 of cash and investments in 2020, and just about $7 million less than that in 2019. So virtually no change, 1.7 billion from year to year. The categorization and classification has changed. We've moved a little bit more towards restricted. Some of the cash that's come in for the bundles has been placed in restricted cash accounts. But I think the positive news is that cash and investments is roughly the same in the aggregate as it was as of 2019. From an accounts receivable perspective, we've increased by about $60 million from 860 to 920 million. While it may be kind of a thought that tenant receivable is driving that process, it's not, because this is a net concept here. The tenant receivable has increased on a gross basis, but we've also evaluated the receivables for collectability, and we recorded additional allowance for doubtful accounts on that. So on a net basis, tenant receivable is not increasing from year to year. What is increasing is we have some increasing amounts from the City of New York and from HUD, relatively, routine amounts that are collectible, but just are a timing issue. Total notes and loans receivable, they are scattered between the current and the non-current category. In 2020, you'll see about 31 million in the current category, and you'll see about 162 million in the non-current category. Those are also after allowance for doubtful accounts. In aggregate, those numbers have increased by about $80 million, and a good amount of that has to do with the recent PAC transactions that we closed, particularly the Manhattan bundle transaction, where we received the purchase money note of 20 million as compensation. In addition, we entered into a $30 million loan participation agreement with HUD called the Sun Loans. So together they increased the note receivable by about $50 million and are explaining that difference. The decrease, the increase in deferred outflows of resources is primarily related to OPEB, and this is also directly related to something we discussed a little earlier, relating to the reduction in discount rate on the OPEB liability, which caused the OPEB liability to increase substantially, which caused some of that expense to be recognized in 2020, about 130 million, and caused the rest to go into deferred outflows of resources. So from a liability perspective, there are a couple of stories here. We have unearned revenues and other current liabilities, which are increasing over prior year. Also in the non-current category, we have unearned revenue, which is increasing by about $150 million. I mean, here is where we're reflecting.
Call you back.
Okay, all right.
Here's where we're reflecting the majority of the acquisition costs, the initial lease payments that we received on the Brooklyn bundle and Manhattan bundle. It's showing up in unearned revenue. And that unearned revenue will be amortized, be recognized over time, over an extended period of years. The claims payable has increased to some extent, also because of a reduction in discount rate. So the reduction in the interest rate environment and investment returns has had an impact on a variety of different aspects of our assets and our liabilities.
Could I ask a question about that?
Sure.
When the properties were put in these bundles and sold, there's cash that comes in. Is that cash just used in, whether it's recorded, it's recorded on the books one way or the other, it's still there. Is that cash invested, or is it actually spent in operations?
I think it depends on what the cash is. Anika, would you like to take this?
Sure, I'm happy to. So the funds are certainly included in our investments. So we invest the cash that we have on hand. There are two types of revenues that we could get from these deals. In a general frame, there are proceeds that are restricted, so things that have to sit in an escrow account that require HUD approval for you to use. And on the other side, we have, our sort of developer fees and items that are unrestricted and can be used by the authority. We generally can use those sort of unrestricted fees for operating expenses. And so we do so at the chair's discretion. He makes sort of the decision about what the funds can be used for.
I see.
And if they're restricted, that's a process that we have to go through with HUD to ensure that we're using them in the appropriate manner and actually get their approval before any of them can be spent down.
Well, so just give me an estimate. For every $1,000 you get in one of these transactions, how much goes into working capital?
That's a great question. So the chair actually set aside $10 million to be used for working capital, but I think we've only spent maybe $1 million of that, and it has been to support the transformation plan. We've actually been pretty judicious about it. As you know, we're in a pretty sort of fragile state with COVID and all of the additional requirements for the HUD agreement. So we've been really careful about how we use those funds.
So effectively, they're not really, the bulk of it's not terribly available for operations.
That's right. So there's a large portion of it that's sitting in escrow. And again, the developer fees we can use and at the chair's discretion, but we have not drawn down a significant portion of those funds. So, about $1 million, I would say. So
the net effect is that cash, which doesn't earn very much now, is just the fact that we have it doesn't do us much good except on a balance sheet. Yes, although I would say that given where we're looking to head in terms of the transformation plan, the reorganization, putting more staff in the field, they're going to be increasing operating costs. And so we are thinking about using those unrestricted funds where appropriate to support the operations. Okay. So to your point, we're thinking about how to make that money work for us, but at the same time, it's a limited amount. So we want to be really careful about the choices that we make. That's a great question. All right, thank you.
Jeffrey, I'm sorry to go back on something because you were explaining it before, but on the summary of revenues, expenses, and changes in net position, we have 3 years, whereas on your draft that you're showing on the screen, you only have 2. And I kind of would like for you to walk me through how we went from a positive to a really, really, really bad negative to a positive again. And that's in the gain and loss on real estate transactions.
Victor, can you explain to me what you're referring to?
Okay. On the summary of revenues, expenses, operating loss, non-operating revenues and expenses, there's a section called gain, loss on real estate transactions.
This is in what was distributed earlier this week?
It's on page 7 of the document that was distributed by Deloitte.
Right.
Okay, bear with me a second while I get my hands on that.
Okay.
That's not something that we have readily available to project, so I just want to.
You were showing it earlier, except you only have 2 years.
Right,
we have
right.
3. I think it's page 5 on your.
Those pages don't correspond. Don't
coincide.
To our pages.
If Carol, could you move to the page following this one?
Talk. I'm in a meeting. I'll call you.
It might be there.
Okay.
Let me see.
So Victor, you're right. We're not presenting the entire set of financial statements.
Right. Okay.
Screen, but I've now.
So it's on this page.
But I've now accessed what you're referring to and what was distributed early this week. So in 2018,
right,
we had very minimal PAC transactions that closed. That's before my time here.
Right.
But what I'm thinking was that it included Baychester Murphy. That's what comes to mind.
Okay.
And there just wasn't a lot of gain or loss activity in that particular year. Then we moved to 2019. In 2019, we had to go through an evaluation of the value of loans that we issued to Ocean Bay Bayside developers, and also to a $90 million investment that we made in the land on what we call Parcel B to improve the land for flood control. And as we went through that value, we determined first that the collectability of the loan and notes was very, very low. And as a result, we needed to provide for a significant valuation loss allowance for doubtful accounts. Likewise, we determined that the market value of the improvements made for the flood control on Parcel B of Ocean Bay were not basically adding to the actual market value. And therefore, it was a sunk cost. So we needed to impair those assets, write them down, and create a loss on the statement of revenues and expenses, which is, I think it was about 165 million for the Ocean Bay transaction in 2019. So that's why you have this wild swing. Without the $165 million loss, you would have had about a $20 million gain in 2019. And it would have looked very much like 2018. And then you move to 2020, and there's more activity. It keeps on building. Every year that we close a PAC transaction, there's more revenue that's going to be earned in future years. That's going to be amortized. It keeps on adding like a domino effect there. And as I indicated, well, most of the transactions in the PAC world are leases, and they're required to recognize the income over time, not to exceed the lease, but generally to be less than the lease term. We did enter into that Ingersoll sales transaction of development rights and vacant land, which was a sale and not a lease. We received $25 million, and the accounting regulations require that we recognize that as revenue immediately. So that's kind of why the spike is there in 2020. I think we would have to normalize the 2019 results to eliminate those unusual transactions so we could see a normal trend.
Okay. Yeah, because we bounced back. Well, I look at it as bouncing back a lot better than we did in 19, because in 18 we were in the positive, in 19 we were in the negative, and then in 20 we were in the positive.
Yeah, so I think in normal circumstances we should always be in the positive, and over the years this should be growing as we do more PAC transactions.
Okay, so PAC is working for us.
Well, I think it's working for everyone.
Okay, all right.
Okay, so Kara, can you go back to page 4 just so we can close out that page? So I think the only notable items we didn't really talk about here was the OPEB liability, which, as you can see, increased by over $600 million. And once again, that has a direct correlation to the reason why the OPEB expense increased, because the discount rate on the liability was dramatically decreased in 2020. And we see the pollution remediation obligation, which is also dropping. Note that we have a small portion of the pollution remediation obligation in the current liability, but most is in the non-current, and it dropped by close to $300 million. And, whether we have to adjust our expected costs for the program is always questionable, and it's based on what occurs in each year. But what will happen every year is that there will be work performed, and there will be remediation, there will be abatement activities, etc. There will be payments for that, and those will reduce the liability. So over time, this liability will go down to zero.
Unlike the OPEB liability.
Yeah, that's a different story.
When I get to people who want to talk about what I do, I talk about how people to guess what the OPEB liability is on the city balance sheet, and nobody comes close.
Yeah, I can imagine. I haven't really reviewed that, but I'm sure it's a much larger number than this.
How about $107 billion?
I can believe it.
Yeah,
that's a big number.
Okay, so I think, as I indicated at the beginning, the financial statements include the statement of net position, the statement of revenues, expenses, and changes in net position, and the statement of cash flows and the notes. And we will be limiting our review to the statement to the first two. I do have in this deck the statement of cash flows. Maybe you can just flip quickly to page 6, Kara. Everyone has seen this, I assume, because it's included in the comprehensive package, but I just want to make sure we have the opportunity to share it with you. If there are any questions, I'll take them. Otherwise, we'll move on to LLC 1.
Excuse me, in the thing we were sent, what page is it in the document I'm looking at?
Page 14.
Oh, thank you.
I'm following the thing that was sent to us, not, I'm trying to
Right.
correlate that to this.
Right, it's actually page 14 and 15. There are two schedules there. So I think with the time allowed, I really don't have sufficient time to review each line item, but I wanted to make sure that where it's there, you have an opportunity to review it. If you have questions, I'd be happy to take them. Otherwise, we'll move on to LLC 1.
If you don't mind, I have one question, so I didn't understand it. On page 15, there's a line that says increase, decrease in allowance for doubtful accounts, other net of non-capital financing activities. What is referred to as non-capital financing activities?
I have to turn to the page. You said it's page
15 in the book that we were sent. And there's a line that says increase, decrease in allowance for doubtful accounts, other net of non-capital financing activities. I'm sure it's right. I just didn't know what that was saying.
Well, there are two different line items for increase in allowance for doubtful account. One is for tenants and one is pretty much for everything else. So we do have allowance for doubtful accounts on other transactions, particularly for, loans and notes and other types of things. So it's basically a catch-all.
Okay, it just wasn't clear to me. Thanks. Not a lot of money on the sheet anyhow.
Okay, Kara, can you flip to page 9 in this schedule, please?
We're going to LLC 1.
Yes.
Listen, I would ask one thing. I have little bits and pieces of suggestions about things that are not quite right in the language. So maybe somebody could give me, I don't want to tie everybody up, but give me a few minutes when this is done and I can point out things that you may want to think about changing the typos and things like that.
I can be available for that.
Okay, well, it's not much, but it's just having read it. One of my pet ones is that the city of New York is capitalized with a V and it's inconsistent in the document. How's that? Shows you at least I read it. Okay, let's go on.
All right, thank you. So we're going to see a lot of common themes when we look at LLC 1 and LLC 2. To start is tenant revenue is down by $6 million, driven by the same factors that we've seen in NYCHA. Total operating expenses are up by $2.7 million. We've determined that COVID-related costs in LLC 1 are $3 million. So it's making up most of this difference here. Subsidies of $109 million is roughly the same as last year. Of the subsidies, $70 million is federal operating subsidy, $28 million is Section 8. And in LLC 1, they also have an allocation of the CARES Act funding, $9 million. But not much change from year to year. And then we go down to special item, and we have LLC 1's share of the expected change in costs of the pollution remediation obligation, $11 million reduction to the liability. Kara, can you go back to page 8, please? Thank you. So looking at the statement of net position for LLC 1, there's not a lot of noteworthy changes other than that there's been a significant flip in the non-current assets from construction in progress to other capital assets net of depreciation. And this is just that many projects were completed or brought to the 95% rule, where they could be converted from a construction in progress to a capital asset and beginning depreciation. But I think in total, the overall capital assets building improvements are pretty much the same as last year. The pollution remediation obligation, most of it sits in the non-current piece. You could see a reduction for the same reasons that we discussed in NYCHA. And other than that, there's not a lot of things to comment in LLC 1. It was a relatively quiet year. Kara, could you move on to page 13, please, to discuss LLC 2?
Could I ask one question, please? The refrigerator and ranges are, say, capitalized threshold. Does that mean you capitalize all of them for 10 years? I didn't know how that translated into dollars. Is that every one of these things is capitalized?
Yes.
Okay. Thank you.
Okay, we're on to LLC 2. And there are some common threads that we discussed previously, but there are also some unique aspects to LLC 2. So I think the first thing I want to discuss is that 4 of LLC 2's developments were included in the 2020 PAC transactions. All right, and that's going to cause a lot of variability in these financial statements in 2020 compared to 2019. That leaves 2 developments as of today that still reside in LLC 2, and they're both scheduled to be included in 2021 PAC transactions. So if everything goes as planned, at the end of 2021, there will be no more developments in LLC 2. And it's very possible that we'll find that we don't need audited financial statements beyond 2021. But that's still to be seen. In the meantime, we have, a variety of different changes in the financial statements as a result of the PAC transactions. Now, the PAC transactions happened in February, and the second bundle happened at the end of November. So at the end of the year, basically the assets, the buildings are all moved off the books of LLC 2. But during the year, for the second bundle, which didn't close till November 30th, they were still on the books. We were still billing and collecting rent from the tenants. We were still incurring the expenses for those properties. So the drops on the statement of revenues and expenses aren't as dramatic as you may expect because 2 of the developments didn't close until November 30th. But still, you see tenant revenue down. Part of that's due to the general economic conditions, and part of that's due to largely the Brooklyn bundle, which closed in February, where we didn't have rent received for most of the year. So from an expense perspective, you see expenses dropping, and that's a little contrary to what we see in NYCHA, despite the COVID-related expenses. And that's simply because we have 2 less properties for almost the full year and 2 less properties for a month, which cause reductions in expenses. But what you do see in non-operating revenues and expenses is a couple of very large dollar amounts there. The first thing is the 4 developments, all of their assets, the book value of their assets after accumulated depreciation was $45,000,083. And those assets were transferred to NYCHA, as a precondition to the PAC transaction. Once NYCHA had ownership of these, NYCHA then conveys those developments as part of the leases with all the other properties that were part of the Brooklyn bundle and the Manhattan bundle. So this loss on transfer of assets in LLC2 is somewhat of what I'll call an intercompany loss, because when NYCHA receives the assets, it recognizes a gain. And when it consolidates the results in the financial statements that you saw initially for NYCHA, it washes out to zero. So this is a loss only on the separate set of books of LLC2s. Was there a question?
No, I wondered about that. Thanks.
In addition, LLC2 receives its funding, most of its funding through NYCHA, and some of its funding through HDC, through a mortgage payable. And any of those loans that related to these 4 developments were either forgiven by NYCHA or assumed by NYCHA and then paid off. So all of those loans relating to these properties were basically derecognized from the books of LLC2 and recognized the gain on forgiveness of debt for $25 million. So these are unusual items, although we'll be seeing it again in the 2021 financial statements, if we're on schedule with the next set of PAC transactions. So I think those are the 2 headlines that just kind of call out for attention in LLC2 statement of revenues.
First of all, there's a concept at the top that says revenues and expenses on a gross basis. What is that? What's a gross is distinguished from what other basis?
Mark, what are you referring to? I mean, I don't see that on my screen.
On page 9, where you were dealing with the program revenues, program expenses, etc., the caption on the top of the page was revenues and expenses on a gross basis.
All right, let me flip through my book and see if I can find what you're looking at. We don't have that on the slide.
I just didn't know what that was telling me.
Page 9, you said?
Yep.
This is for LLC2?
Yep. I just didn't know. I'm trying to figure out when I looked down below as to what it was telling me. And why it was saying it that way.
Okay, I'm now looking at that schedule. I'd appreciate if you can repeat your question.
The top of the page says revenues and expenses on a gross basis, paren, dollars and thousands, close paren. And this is the schedule. It starts with program revenues, program expenses, etc. And what was that supposed to tell the reader?
Well, I mean, this is not part of the basic set of financial statements. This is part of the MD&A, and I believe it's a requirement of the GASB or the GFOA. I truthfully don't see a lot of additional value in this schedule. What it's really doing is it's taking this statement of revenues and expenses, and if you look at what's on the screen, you'll see that we group revenues and expenses together in non-operating and operating categories.
I'm looking at something else. The one I'm looking at has 3 years, and it starts off with subsidies for 2020 at $27 million. So it's not what you're looking at.
Yeah, I think the only difference is there's a geographical difference. The schedule that you're referring to basically takes all positive items and lumps them together into revenues, and takes all negative items and lumps them together into expenses.
So that's why it's gross. I got it.
Right. And when you get down to the net position at the end of the year, the loss before capital contribution, you end up at the same place. I mean, I'm not sure that there's a lot of additional value to the schedule, just moving things around, but it is a requirement. But as I said, it's not part of the basic set of financial statements, and it doesn't go through the same audit process that the basic set of financial statements go through.
What I'm looking at is different than what's on the screen, that's all.
I understand.
That's okay. Okay.
Okay, so I think the last page that we'll go to is, Kara, if you can move to page 12, please.
Yes. Can you call later? Bye.
So this is a statement of net position for LLC 2. And, you know, where we see a lot of change is in the total non-current assets, where there's a major drop off in the construction in progress and the capital assets. You know, these were assets that were largely transferred to NYCHA, and we saw that on the statement of revenues, the $45 million of transfer. In addition, you'll see the mortgage payable, particularly in the non-current liability, and the loan payable to NYCHA, also in the non-current liability, you know, being dramatically reduced. And there were some small principal payments during the year, but largely this reduction was due to the forgiveness of debt, which we saw in the statement of revenues and expenses. And pollution remediation liability, there's a very significant drop here, particularly in the non-current piece. And while part of this is due to the same factors affecting NYCHA and LLC1, the majority of this is due to the fact that the obligation for pollution remediation has been removed as they transfer the assets to NYCHA. And likewise, when NYCHA enters into a PAC transaction, it reduces its pollution remediation obligation.
Now, when these pollution obligations were transferred over, as I understand the rule game, that you can't get rid of pollution obligations by merely transferring it someplace. That obligation, somehow the obligor is the new company. How does that relieve the old one of an obligation? Because I understand, I mean, when I've done these things, they always look at the fact that how good is the new, I guess, if the new obligor is good, somehow you don't worry about whether or not the old one will have met its obligation. Is that it?
Well, my understanding is that the developers that take on the rights and responsibilities also take on the obligations of the property.
Oh, I understand that, but I myself had a recent sale personally of some real estate, and I went through all kinds of contortions because just by selling it to somebody who said he'd take it on didn't relieve me of my obligations. And I had to get an insurance policy or something to do it.
Well, this is something that we can further discuss with Dan Green and get back to you with a complete response.
If somebody was satisfied that somehow the transferor relieved itself of the obligation by transferring it to the new company, okay, I don't know enough about the technology there, but I have personal experience with how hard it is to get rid of it when you sell something.
Okay, we will ensure that we review this and respond to it.
Thank you. I assure you mine was a much smaller pile of money.
So with that said, I'll take any additional questions.
As I say, I'll give you the nits and the bits, whoever you want them to, in offline conversation.
Okay, well, that would be me.
Okay, well, then we can talk about when we do it. Okay.
Okay, well, thank you, everyone.
Thank you.
You,
I must say, I appreciate the presentation, its thoroughness and its succinctness. So thank you.
Thank you.
Well, thank you.
Thank you
And-
very much.
And
Jeff.
so somebody will get back to us when on the PAC question I had raised earlier.
Yes, so Mr. Koo, I already contacted our EVP of Real Estate, Jonathan Gavaya, and so he's happy to set up some time to talk with you if you want to. Do you want something in writing or would you prefer a conversation?
No, I think something in writing would be fine.
Okay, we have FAQ documents and other sort of, documents that we've put together over time. We can send those over to you.
Okay, thank
Today.
you. Thank you.
I guess
Okay.
we know.
Thank you very much, Jeff and Anika from the Finance Department. Gonna go now to Deloitte and Touche for the Audit Committee letter, SAS 114, and the Management Rep letter for the 2020 audit. Jill?
Thank you. Good morning, everyone. So in front of you, you have our annual charge with governance letter, which Deloitte is required to provide to the Audit Committee of NYCHA. This letter will take you through the results of our 2020 audits of the authority and the LLCs. So just want to remind everyone that we're auditing the financial statements in accordance with two sets of auditing standards that were established by the AICPA, as well as standards established by governmental auditing standards. We're currently in the process of completing our audits for 2021. We expect to be completed with our work later today, and we'll be in a position to issue our reports final today. Of course, pending your approval of the financial statements. Next page. The next page outlines our responsibilities under the auditing standards. It's to express an opinion on the fairness and presentation of the financial statements, disclaim an opinion on the required supplementary information. We also issue an opinion on the supplementary information in relation to the financial statements as a whole. In December, when we issue our reports related to the single audit, we'll also issue our report on internal control over financial reporting and compliance. And at that time, we'll also issue our report in accordance with uniform guidance. Next page. Significant accounting policies within the notes to the financial statements, which you have in front of you. Note 1, the authority's management lays out the significant accounting policies which are used to prepare the financial statements. As the auditors, we are not aware of any changes in previously adopted accounting policies or their application during the year. There were no new GASB pronouncements that were required to be adopted in this year. There are a number of estimates that are used to prepare these financial statements. Some of those estimates relate to pollution remediation, OPEB and pension liabilities, claims estimates, depreciation factors, and market value of investments. The key estimates are laid out in Appendix A to this letter.
While you're at it, there is a reference to in one of these things, I don't know, Appendix A, it says as of and for the years ended, but only refers to 2020. Is the S a typo or there's some years we should be seeing?
It's a typo, Mark, and if it says years, it should just be 1 year, 2020.
Okay.
There were no uncorrected misstatements that were identified by us that during the year. There were actually no material corrected items that were brought to the attention of management either.
Let me interrupt you again because I asked this of all the accountants. The statement that there are no material uncorrected misstatements. Were there anything that was uncorrected?
No.
Okay, thank you.
You're welcome. We have not had any disagreements with management throughout the course of our audit. We're not aware of any consultations that management has had with other accountants about auditing or accounting matters during 2020. In our judgment, we received the full cooperation of the authority's management and staff, and we were provided unrestricted access to the authority's senior management during the performance of our audits. We have had discussions with both the CEO and chair, the general manager, compliance, director of compliance, CFO, and controller during the course of our work. I do want to just highlight one item. I believe, I can't remember if Mr. Koo or Mr. Gonzalez brought this up at the earlier meeting this year, I think back in April, related to an extrapolated item that was communicated to you last year. Last year we had, in this letter, we had communicated to you that there was a potential misstatement of approximately $45 million related to three items, documentation related to three items, which was actually with federal authorities in another state related to lead paint. Those three items were provided to us during the course of this year's audit work. The audit evidence that was provided was satisfactory. And I am pleased to state that that $45 million extrapolation is no longer warranted or needed to be communicated to this committee. Finally, attached to this letter is the management representation letter, which management is required to sign and provide back to us prior to the release of our auditor's reports. At the request of this committee, we have highlighted or tracked the changes made from the last year letter to this year letter. There were some changes, I would say most just, editorial or grammatical changes that were made from the prior year to this year. I would say the biggest change to the management representation letter this year relates to the removal of the single audit representations. We will be including those representations in a letter in December prior to the release of the single audit related reports. In addition, this year, we also added a representation related to GASB 87, which is the new lease standard that will be adopted by the authority in 2022, as well as a representation relating to CARES Act funding, CARES Act funding. Next page, please. There are a couple of emphasis of matter paragraphs within the auditor's opinion for the LLCs and NYCHA. These emphasis of matter paragraphs are consistent with prior years. Most of the, or I guess three of the other matter paragraphs relate to the inclusion of RSI. Required supplementary information. GASB requires such required supplementary information, and as a result, we do have to make note of it in our auditor's report. And then for the two LLCs, we have an emphasis of matter related to the fact that they do have significant transactions and receive significant subsidies from NYCHA, the authority. None of these other matter paragraphs or emphasis of matter paragraphs modify the opinion. You still have clean opinions on all three reports. I do not have any significant deficiencies or material weaknesses to report to this committee. And with that, that concludes my prepared remarks regarding the results of the 2020 audit. If there's any questions, I'd be happy to answer them.
No. I did appreciate your marking the changes in the rep letter, though.
You're welcome. I try not to forget, Mark.
I asked that of all the auditors.
All right, thank you very much, Jill.
Well, Jill, let me ask you a question.
Yeah.
There's two other pages on in our document that you haven't covered.
Which two are those?
The ones following.
Oh, the estimate. I can go over the estimates. Yeah. I can go over those if you'd like.
Well, I mean, the issue I'm concerned about is the last paragraph, control related matters.
I mentioned this at the onset, Mr. Ku, but I'll just mention it again here. When we issue our single audit reports in December, there will also be a report included in that package that relates to internal controls over financial reporting and non-compliance.
Okay.
So we will be issuing that report in December along with.
Okay, so therefore this paragraph will be deleted from this particular presentation?
I'm actually required by the standards to include the paragraph here to let you know that a report on internal controls will be issued at a future date.
Okay, but the way it's reading right now is it says you will be reporting it on or about today. So you're going to change that. You're going to change that from June 17th to December or whatever it is?
Actually, our report date will be June 17th. We just won't issue it until December. So the report date and all of the audit work related to this report will be completed today, but we will hold issuing it until we issue the single audit report.
I see. Okay. Okay. Thank you.
You're welcome.
Okay. Thank you.
You're welcome.
Okay.
Any other questions?
Nope.
No. I certainly don't have them.
Okay. So we are at process for recommending the approval of the audited 2020 financial statements to the board. Motion is in order.
Motion.
Yes, Mr. Gonzalez, move. Thank you.
If anybody wants my nits, you can have them. Otherwise, you can leave it alone.
Mr. Kaplan, we will take them. Jeff will speak with you and get all the typos and edits.
Right.
Thank you.
Okay.
Okay.
There's nothing significant.
We have a
Anybody second?
Second to the motion.
Second.
So moved.
That's been moved by Mr. Gonzalez, second by Mr. Kaplan. All right, all those in favor that this report be submitted to the New York City Authority Board, 2020 financial statement, here say aye.
Aye.
Okay, it has been unanimously approved. So this will go to the board. Thank you very much, members. Again, we have Deloitte, and they will give us a status update on the 2020 single audit of NYCHA.
Thank you. I'm going to have Darshan Patel, my senior manager and my single audit specialist, take you through where we are as far as progress related to the single audit, which once again, we'll be planning to issue this in December timeframe.
Hi all, good morning. This is Darshan Patel.
Hey,
how are you? Good. How are you?
All right.
So in April of this year, we did the planning, and we determined that we have to use the 4 programs audit. Four programs will be audited in April, but after April, and between April and now, there was one program called Public Housing Operating Fund. Is a new CARES fund, and we thought that we have to audit that program at that time. But the OMB has changed the regulation, and it was part of the Public Indian Housing Operating Fund. So we do not have to audit this year, but we will be auditing that next year. So that was the change we made from the original presentation in April till the slides you have in front of you. this year we're still going to keep the same programs, community development program, housing voucher programs, and public housing capital fund. So we're going to audit 3 major programs. Management has provided the population for the programs, and we have selected the samples. They're in the process of providing documentation to us. We are still on time to issue this thing in middle of December with the 3 major programs. And we will also be submitting REACT submission in December, but we are on time. We are on time to issue those reports at that time. Any question on the programs I'm auditing, like housing voucher choice? It has one of the CARES program, by the way, which we will be auditing as part of the program.
Yeah, the HCV CARES Act funding.
Yes.
Can you kind of go through that exactly where we're at with that?
No, management provided the population.
Okay.
All the expenditure. It's about $1 billion in this program, by the way. It's a huge program, $1.1 billion. And management provided the population. I am still in the process of selecting the samples. We'll be selecting quite a few samples, and part of that will be in the CARES Act. And then we're going to start our procedures on that. But yes, we already got the $1.1 billion expenditure on this program.
So I got a question. The Section 8 housing choice vouchers.
Yes.
Okay, that's part of this cluster.
Yes.
Is that the new Section 8 where they're talking about the conversions, or is this a program on its own? Program
on its own.
Okay.
HUD provided to NYCHA two CARES Act fund. One is called Housing Choice, and another is called Public Housing Operating Fund. 2 programs, about $120 million. And they are saying they are not separate program, they are part of the cluster. And that is why HCV CARES Act is sitting with the Housing Choice Voucher Program, because all those 3 programs is considered as one program, and we'll be auditing all 3 programs as part of one program. But it is 3 programs sitting there.
Yeah, Mr. Gonzalez, HUD actually just gave the CFDA number of 14.HCC. HUD gave that HCC designation so that it was clear that related to CARES Act funding. Same with the public housing operating fund. It ended in, I think, PHC. And again, that designation was made by HUD, so it was clear that those were specifically CARES Act funding or related to CARES Act.
Okay.
Versus what I would call what you would normally see in a year outside of COVID.
Okay. All right. I was just curious. You have it here on the page that I'm looking at, the Public Housing Capital Fund.
Yes.
So is that what you're referring to as the operating fund?
No. Public Housing Capital Fund is separate than Public Housing Operating Fund. Public Housing Capital Fund, just give an example, this year is roughly goes between about $400 million. Public Housing Operating Fund, by the way, is much higher, and it goes about $900 million.
Oh.
Just to remind the committee, we audited the operating fund, was it last year?
We operated operating fund in 2018. 2018.
And so we're required to audit every major program at least once every 3 years. And since we've audited the operating fund in 2018, it will be up for rotation again for testing next year. So in our plan back in April, it was on the list. And the reason it was on the list is because of the CARES Act funding dollars. We thought that was something that was needed to be scoped in and considered major for this year. HUD, between April and now, HUD has actually issued some white papers and some directives that describe this program. And as a result, it's not necessary for the auditors to test it this year. Essentially, you can go back to your rotation plan. So that was why we modified it. We had this program, the operating program, in the plan in April. It's now come off the plan, and we'll audit it again in 2021.
Okay.
With CARES Act funding, and it's common whether it's public housing in HUD or whether it's healthcare providers or transportation organizations, but the CARES Act funding and the rules by which both the auditee and the auditor need to follow as it relates to these CARES Act funding, it's constantly changing. We just heard about a change, I think, last week on healthcare provider funding. And so it's kind of causing ripples across the industries, both on the auditee and auditor side. So we're constantly moving alongside this with OMB and the federal awarding agencies.
Okay. Okay.
It's a very
I didn't know.
unique situation.
I didn't know that the changes were that quick.
Yes.
Yeah. We're telling them to stop changing.
Okay. Well, that's all the questions I have.
Okay. What else? Any other comment? Any question? All right. Thank you very much, Jill and Dashon.
Thank you
for your presentation.
I have a quick question.
Yes,
under the CARES Act, is that going to allow you to fund in part the PAC transition from PHA to Section 8?
No. So the CARES Act funds, the public housing operating funds that where we allocated the $150 million grant, of which we recorded $120 million in revenue in 2020, that was to support the public housing program. So we used it for maintenance and operating, and also to support COVID-related activities. And in the Section 8 side, we were given, I believe, $37 million from HUD, and I think we recorded about $10 million in 2020. Jeff, if that's wrong, please step in. And that is to support the Section 8 program. So HUD gives a list there. The public housing operating is a bit more flexible, but HUD gives a list in the Section 8 program with regard to what you can spend on. Some are COVID-related activities, and some items are also just general activities to support the Section 8 program.
Well, that's why I raised the question, because if some of the PHA housing is going into Section 8 under the pact, they're presumably going to be renovations and capital and operations improvements and so on that have to be made. And so the question is, can you use CARES money to pay for that?
No, you cannot. So when something leaves the public housing program and goes into Section 8, you cannot use public housing funds to support that property any longer. So if it left through PACT, I can't use public housing operating CARES Act or any other public housing funds to support anything in that development. We have to make a very bright line.
I see. Okay, thank you.
So Richard, sort of like to kind of clear something up, the moment any of these properties convert, we're no longer considered public housing residents anymore. We're considered Section 8 residents.
Right.
So it knocks us out from any public assistance, so to speak.
But NYCHA is still responsible for the maintenance of those buildings, or no?
No, not at all. The private management companies are the ones that now bring their own skilled trades and everything with the whole kit and caboodle. NYCHA does not come in here at all, except for overseeing the property and the 99-year lease.
But I thought NYCHA was still responsible for dealing with the operations and maintenance.
No.
No, okay.
No.
Under the old RAD, it was. I guess under the new, it will not be. Okay.
Okay.
Okay, thank you.
All right, thank you very much again.
Thank you.
Jill. Do we have any other business, any matters to discuss?
I thought we should go into executive session as we did in every meeting.
Okay.
And discuss What? Oh, well, no. I
If that is the case of the members, then the motion is in order.
I so move. By the way, if anybody wants my comments, the phone, my phone number is 845-657-8323. That's my landline. My cell phone isn't working properly.
Mark, can I ask you to repeat that?
845-657-8323. I'm sorry, we've had big problems here.
Thank you.
Okay, then if we would like to go into that session, do we have a motion for it? And I think the language, you want to follow the open meeting law language.
I so move.
Okay, it has been moved. Seconded.
Second.
All right. Members will now proceed into an executive session of the NYCHA Audit and Finance Committee. Kara, can you assist us in this regard?
Yes, so I put the join link in the chat. So remember, on your dashboard, you need to go to chat. I know some of you all needed to click on more and then hit chat. You need to do that now. This is only for the executive members. For the executive session, there should only be 5 people in there. I'm going to go in there as well. So Mark, Richard, Victor, I'm pretty sure it's Jill and Johnny. Please go to the chat.
We go to chat.
Go to chat and click on the link I just put in there, please.
I just clicked on chat.
Okay, and I put a link in there.
Oh, I see. Join link. Okay.
I don't see the join link.
You got to go to more. Oh, chat.
Chat again.
Just to be clear, so this executive session is with the committee members and Deloitte as well?
Uh-huh.
Okay, thank you.
Well, what gets...
So Mark, click on chat, and then when it pops open,
then what?
you need to click on the link.
further business. Is there, gentlemen?
No.
No? Mr. Clark, any further
Yes,
business?
so a motion is in order then for adjournment of this Audit and Finance Committee meeting of the New York City Housing Authority for today.
So moved.
17.
Second,
Can you please hold? I think AV team needs to be there. I'm not sure whether they are there.
Who needs to be here?
Audio visual team.
Yes.
Okay.
So-
Victor, may I make a suggestion that you make the motion to adjourn?
Yeah, okay.
Yes, but we gotta wait till he says
Yeah,
the
I know.
people
So
join
is
us.
the ABP, but as co-chair of this committee, you should make the motion to adjourn.
Yeah.
Okay,
Yeah. So
are we ready, Anil?
okay. So Andy. Yeah. So Andy and Umberto are back now. So
Okay, so I'd like to make a motion to adjourn this meeting.
second.
So moved.
Any second it?
Yeah.
Second.
Okay, all in favor?
Aye.
Aye. So the meeting, the move is made and finally the meeting is over.
Thank you.
Thank you
All right.
very much,
Thank
Mr.
you very much,
Kaplan, Mr.
everyone.
Gonzalez, and Mr. Koo.
Thank you very much.
We hit.
Thank you very much, support team, Kara and Ramon and Johnny Wise and Deloitte and everyone. Take care.
Thank you all. Have a good day.
Okay.
Thank you.
Official
very
close
much.
is 12:02, correct?
Okay.
guys.
Yes.
Okay, bye, everyone.
Bye.
All right, bye-bye.